Forex Focus brought to you by IG. Taking a look at the crazy price action we've seen in US dollars over the course of the last couple of days, really to start 2024, the dollar surging against yen and Australian dollar primarily, some of the biggest moves in those pairs, but also up against all the majors. And we'll talk about plenty of those major Forex pairs. But starting with this story in Japan, because this was really heading into 2024, looking like it could have been one of the big anti-dollar stories or dollar bear cases. As you'll remember, the last couple months of the year, dollar yen went from above 150 all the way down to 142 and even lower for a couple of days to conclude the year, with the idea that, okay, the US is going to cut rates, the dollar is going to give back some of its strength. The Bank of Japan was even talking about maybe coming out of negative territory for the first time in years. And so not only, this divergence that we've seen in the last couple of years, not only US coming down, but maybe Japan even coming up. And a lot of that has been unraveled in the first couple of weeks of 2024. Dollar is up 4% against the yen, more than 500 pips in just the first couple of weeks of the year. Bank of Japan is backtracking on some of their more hawkish thoughts at the end of last year for a multitude of reasons within their domestic economy. And we've seen this story play out a couple of times in the last year or so since the global rate hikes have stopped, really, especially in the last 6 months. You had the Fed, the Bank of England, the European Central Bank, Reserve Bank of Australia, and Canada's central bank as well, all kind of say in the last 6 months, okay, we're looking at least stopping the rate hikes for now and maybe rate cuts in the future. And the U.S. was one of the first central banks, major central banks, that is, to talk about that in December of last year. And that caused markets and a lot of traders to think, okay, well, now the dollar is really going to give up some of this downside. It was the leader on the way up, and now it's going to be the worst performer on the way down. But whenever you get in this mode of this has to happen, the U.S. has to be the fastest and furthest with interest rate cuts, because that's how they were to the upside with the hikes. You have to remember that markets can do whatever they want, and you can absolutely get a global dovish environment, which is to say central banks globally committing more growth-oriented open market operations and moving rates lower or buying more securities or whatever the specific central bank would do. And the U.S. can still relatively outperform. And we've seen some of that in these first couple of weeks. And it's not only the yen, it's also this Australian dollar that was another one that heading into the end of the year was one of the feel-good stories. It had bounced back from those lows in October, trading around 63 cents, even lower for a couple of days there, all the way up to above 68 cents, which is a huge move over the course of about 2 months. And now giving back a lot of ground to around 66 cents here, middle of this range for the last couple of months. And again, that 63, 64 low is absolutely on the table, only a couple hundred pips away. And to start this week in particular, the dollar, the US dollar, has appreciated around 100 pips against the Aussie. And so right there tells you how capable it is of getting back down to these lows, as the US dollar is really appreciating against a number of majors, but it has been primarily this Japanese yen in this Australian dollar piece, more on that geographically in a second. But first, where's the U.S. strength coming from? And no coincidence at all that U.S. interest rates have bounced back over the course of the last 2 or 3 weeks to start 2024. 10 years are back above 4% for the first time, really since that December FOMC in the mid December range there. And also, I took a look at this earlier today. 30-year yields have climbed back well above 4%, and they've, over the course of the last 2 or 3 weeks, have surged 30 to 40 basis points, a really big rally in long-term interest rates as well. And what this is doing is pricing out some of those interest rate cuts that were priced in at the end of 2023, as you saw, especially in that range of October, November through the end of the year. The 10-year goes from around 5% to below 4%, essentially 100 basis points lower, with the idea that the U.S. is going to start cutting rates. And by the end of 2023, the market's expectation was, oh man, maybe 5 or 6 of those 25 basis point rate cuts to get the U.S. overnight rate from above 5% to close to 4%, where these futures were trading really across the yield curve at the end of last year. With this recent rise in especially long-term rates, the idea, the market is, of course, the Fed can end up doing whatever. They haven't cut yet, but the market is projecting still some rate cuts in 2024, but maybe not as many as previously thought a month or two ago. And so you're getting some U.S. strength from that U.S. specific story. And a lot of this coming from the recent inflation data and employment data. Non-farm has been better than expected the last 2 months. U.S. inflation was higher than expected at its last reading, and heading closer to mid 3%, closer to 4% than 2%, the target from the Fed, and still hasn't fallen below 3% in more than a year. Obviously, it's well off its highs, but not at that 2% target that the Fed talks about. And so you're seeing some strength from the U.S. data that, yeah, you might say, oh, high inflation, I don't want that. Why would the U.S. economy be strengthening off that? Well, it's not, the 6, 7, 8, 9% inflation that we've seen at various points over the last 2 years. It's a little higher than they wanted, but it's in that nice little range that kind of shows the U.S. economy is strong and it's performing well, and maybe a little bit too well. But that's where you're getting some of the relative strength to places like Japan and China, where they're not seeing some of these strong numbers. And with that, I want to get into this Chinese piece a little bit, because you might say, well, Frank, you haven't talked about Chinese currencies and not part of the major pairs story that you led off with. When I think major pairs, of course, I think about the euro and the yen and the pound and the Australian dollar, Canadian dollar. And I'm not talking necessarily about Chinese currencies, but I am talking about the Chinese economy globally, one of the largest, and neighboring territories like Australia and Japan, highly dependent, and even to an extent, Europe. And we'll get to that in a second. But you take a look at this, and this is a Chinese stock ETF, FXI, and economic data has not been so kind to China. It is trading through its recent lows, and you add a couple decades of data, and you see right now FXI trading around $22, some of the lowest prices that we've seen in the last almost 2 decades. The Chinese stock ETF has only traded below $20 a handful of days back in 2008. And then before that, you have to go back to, I think it's 2004, 2005 range to find it consistently trading below $20. And if you were to line up a chart of NASDAQ or a US stock index or stock ETF, you would see very different price action over the course of the last 15 to 20 years. And why is China seeing some of this poor performance and this negative correlation to the US dollar? As you see, the last couple of years, really since the pandemic, Chinese stocks have been negatively correlated with the US dollar. And a lot of this has to do with the fact that China was able to bounce back from the stock crash, the economic crash that we saw right at the outset of the pandemic. It bounced back with the U.S. and the Euro area and the U.K. and everybody else. But since then, China has actually seen some of its worst economic data since the 2010s or even the aughts, as they've recovered from the pandemic, but they haven't recovered to pre-pandemic. Whereas the U.S., like I said, the NASDAQ made new all-time highs at the end of 2023, and it's close to its highs. Same with the S&P. We're still seeing inflation and GDP and employment in the U.S. that's a little bit better than expected. Hopefully not in that hyperinflation territory, but solid and staying strong even over the course of the last couple of years, where we saw that pandemic crash, huge rebound, and then inflation-based crash lower in the last couple of years. And you see here some of that correlation, negative correlation to the US dollar, but positive correlation, especially to a forex pair like the Aussie. In that black line is FXI, the Chinese stock ETF over the last year or so. And then in the background is the Australian dollar versus the US dollar. And you see a similar general trend, and especially the last couple of weeks to start 2024, movement lower in Chinese stocks, movement lower in Australian dollar, and the resurgence of the US dollar. And for example, 32.2% of Australia's trade comes from China. And so obviously a big portion of the economy, and places like Australia and Japan saw the Japanese yen also moving lower, and dollar really resurging against Japanese yen, a little bit of it at least, owing to the movement lower we're seeing in the Chinese stocks and Chinese economy. Now, there's going to be more data coming out of China in the next couple of weeks. They've got GDP data. Their trade balance is always important. And so we'll continue to monitor not only Chinese stocks, but Chinese economic data to see if there can be a bounce back or a reversal lower, bounce back for Aussie or yen, or a reversal lower for the US dollar. But for the time being, a lot of the stories that people were writing at the end of 2023 calling for the dollar to finally move lower and euros above 110 and pound back to 130 and beyond, and Aussie bouncing back, yen bouncing back. Man, a lot of it's been undone to start the year as the dollar continues to resurge, but we'll continue to monitor where it goes from here.